So let's start and earn money with Forex market.
Hello guys and welcome back to another class of our course about trading the Forex, the complete introduction. So in today's class, we are going to talk about creating your Forex trading strategy. So congratulations, until now we saw what's fundamentals, what's technical analysis, what's money management. So you should have absolutely all the knowledge to be able to create your first Forex trading strategy. So my goal in this class is really to introduce you what exactly should be included in a Forex trading strategy and what exactly you should look at when you are creating your own strategy. So let's start. All right, so the first thing that you guys want to do when you are creating your strategy is deciding your trading style. So when I'm saying deciding your trading style is, are you someone who wants to trade on the long run? So you are more of an investor than a speculator or a trader. So you want to invest, let's say, on a 1 month period. So you are ready to put your money, you are ready to have wide stop loss, but you are looking for higher profits, really high profits, and you are looking to not trade at all, just place your trade and then forget about it and let it move. Well, in this case, you will look at higher time frames. Your strategy should include, as I said, higher time frames and not smaller time frames. If you're someone who likes stress and who wants to trade, let's say right now, who wants to put the maximum amount of trades per day, that's you will be a scalper in this situation. And in this case, you should trade really smaller time frames. So you really should decide your trading style depending of what type of personality you have. If you want to trade daily, well, in this case, you'll be a day trader. In this case, you will look at the charts that are in 15 minutes, 5 to 15 minutes. Those are charts for day traders, people who are trading daily. If you're more of a swing trader, like someone who trades once a week, once every 2 weeks, who plays trades for like 2 week for a 2 week period, well, in this case, you will look at charts in 1 hour period, 4 hours period, and all this depends on you. So the first thing that you will have to ask yourself before even starting your strategy is what will be your trading style, and how exactly you will trade when you will start your trading career. All right. Second thing will be deciding the risk you will take per trade. So in this case, we are talking about a risk in percentage. So how much you are ready to sacrifice on each of your trades, how much of your wallet or of your capital are you ready to put at risk on each of your trade. So let's say, for example, you have $1,000 in your account and you're ready to put at risk on each of your trades, let's say $20, which is 2%. So your risk will be 2% in this case. So you decide your risk and you always stick with this risk. So let's say you make losses, well, you always stay with that 2%. You don't start to overtrade and take a huge amount of risk to try to take back the money that you lost. So second thing, you decide the risk that you want to put on your trade. All right, so when you decided your trading style and you know exactly what type of, how much risk you will take per trade, the next thing that you want to do is decide the importance that you will give to fundamentals. In this case, you will decide if you will use fundamentals in your trading or no. So, for example, will you trade when there are major events? Will you, for example, trade on fundamentals? Will you wait, for example, for the GDP of a certain country to appear to trade this news? Will you be someone who will trade news? Yes or no? So that's an important part of trading because fundamentals are really, really huge in trading. I don't say that you have to choose to trade with fundamentals or without them. I'm just saying that for the purpose of creating your strategy, you will have to decide if you will use fundamentals as main source of your strategy, or you will just check at them once in a while and your strategy will work with or without them. So you don't really matter. So that's the question that I'm asking you. So that's exactly what you will do. So you decide how much importance you will give to fundamentals in your strategy and if you will trade fundamentals. All right, so when you decided those 3 points, the next thing you want to create your strategy. So when I'm talking about creating your strategy, it's really from a technical point of view. So you will sit down in front of your charts, you will open up your time frame that you want to trade. So let's say you want to trade on daily, you will open up 15 minutes time frame. And at this point, you will create your strategy. So the strategy could be with indicators, could be only with price action, could be indicator and price action, could be, I don't know, with fundamentals. You decide. Everything, all this is really, really up to you. And at this point, your goal will be to create your strategy. When your strategy is created, so it could be a strategy on long term, short term, mid term, strategy, let's say, that can be traded on a daily basis, on minutes, or a strategy on months. Well, the last thing that you want to do is test your strategy. So at this point, you want your strategy to, you want to be sure that your strategy works. So how exactly will you do this? Very simple. You will backtest it. So you'll simply open up your graph, your chart, and you will backtest your strategy on at least 6 months. And all this will depend on your trading style. So what this means? This means if, for example, you are a day trader, you are trading on 15 minutes chart, well, definitely you will test for at least 6 months. If you are someone who is a swing trader, in this case, I suggest you to test your strategy on at least a 2 to 3 years period, because the more you have data about your strategy, the more you know how your strategy works in the long run and how your strategy will adapt to market conditions, the more you can be sure that your strategy will work. Well, not sure, but the more you will have confidence in your strategy and that it will work in the near or in the future, because in the past it worked. And if your strategy is good and the way that you tested, when you back tested the strategy, it had survived to all market conditions, well, this means that your strategy is good and that you can use it for your own trading. But once again, very important, don't forget to backtest it. So let's summarize everything we saw today. So the first thing you guys want to do is really decide your trading style. So that's the first thing. You sit down, you decide if you want to trade on a daily basis, if you want to trade on, let's say, weekly, bi-weekly, you decide. So that's the first thing you want to ask yourself. And what's your personality? If you're someone who's stressing a lot, well, it's maybe better for you to place one trade every 2 weeks or even one trade every month. So your strategy should be around this. So you will work with higher time frames. Next thing, when you decided this, well, you decide the risk that you will take. Of course, it's going to be in percentage of your capital. So if you have $1,000, well, how much will you risk on this $1,000? Per trade, of course. We are talking about risk per trade, and you will keep this risk forever. Well, forever, for the beginning. Next thing, you want to decide the importance that you will give to fundamentals. So you decide how fundamentals will be important in your trading and if you will use them or no. Then you will create your strategy by the use of indicators, by the use of price action, and by everything that we learned today or in this course. And finally, you backtest your strategy. That's the last part. You backtest it, you open up your chart, you go back at least 6 months, and you backtest your strategy. Even you can backtest it on multiple currencies to verify if the strategy works. Finally, if everything goes well in all this, you can start trading your strategy. And normally everything should go the right way. If, of course, you don't let your emotions get in the way. All right, so that's it for this course, guys. You saw how to build a Forex strategy. And in the next class, we are gonna create a strategy together. And I'll show you how you can create it. We'll create the technical part of the strategy. So that's it for this course, guys, and see you all in our next class. Hello guys, and welcome back to another class of our course about the complete introduction to Forex. So in today's class, my goal is really to help you create your first trading strategy and we're gonna do it step by step. You'll see it's gonna be really easy. We'll use indicators and a bit of price action to set up your take profit and your stop loss as well. All right, besides of that, we are also going to talk about where you can put your results, because you want to look at all your results about your trading, and I'll show you the small Excel file that you guys can do to be able to look at your results after that. All right, so until now we talked about the fundamentals, technicals, and money management. So you guys should have a good understanding of the indicators that we talked about. For the first strategy that we are gonna use today, we will only use one indicator and a bit of price action to set up the take profit and the stop loss. So the first thing we are gonna do is simply go here, click on insert, indicators, and we'll insert the MACD, which is just there. All right, so you guys have the MACD or the MACD just there. And our goal, how the strategy will work, our entry point will simply be when the histogram changes. So let's say, for example, we are somewhere here. Our entry point will be there. So right here, the histogram goes from buy to sell signal. So right here, we have our sell signal. We are going to sell just there. So right now we have our entry point. So we know exactly where we will enter the trade. The next thing that we need to understand is where we'll put our stop loss and where exactly we'll put our take profit. So my goal right here is really to have a strategy that can bring money in the long term, and not a strategy that just works for 1 or 2 trades. So basically my take profit will be something around 1 for 2. So for each risk of 1 pip, I want to make 2 pips. So this is a minimum. So it will be 1 for 2 or 1 for 2.5. If it's too low, well, I will not make money on the long run. And if it's too high, once again, I will have a lower winning rate for my trades. So how exactly will I set up my stop loss or my take profit? So once again, let's take another example. So let's say we are here and we are opening our trade somewhere there. So here is our opening. Sorry, not here, just there. So the first histogram that is on the other side. So we are opening up our trade here. Here we have our opening. Our stop loss will simply be the highest point of the 3 previous candles. So in this case, we have our 3 candles, 1, 2, and 3. So this will be our support. We don't want to go higher than this. So we are ready to take a risk that goes from here to there. So this is our risk. We have a risk of, in this case, 73 pips. Once again, this is an hourly chart. If you're working with smaller charts, maybe you will have a lower risk. If you are working with higher charts, well, maybe you will have a greater risk. So as I said, your risk will be something about 73 pips. The next thing you guys want to do is set up your reward. So as I said, the reward will be at least 2 times the risk. So if we place our trade here, our reward should be around 140 pips, which in this case is there. So here we have our reward. All right, amazing. So we have our trade, which will open there. Our risk will be here. Our reward will be here. So we have an interesting trade, and our profit on this trade would have been 140 pips, which is an interesting profit and a nice risk reward. But don't forget, this type of strategy doesn't win 100% of times. You will have losses, and you will need to have a good money management to be able to handle everything. But let's say, for example, you risk 2% of your capital here, you would have made 4% in this trade, which is a really good thing. If you have let's say, if you have $100,000 of capital, you just made $4,000 in a matter of some hours. All right, let's find out another place. So let's go, for example, here to see if it works. So at this place right there, we have our, let's say we have another place where we can place the trade. So our trade will be here. And once again, our stop loss will be somewhere, will be the highest point of the 3 past, the 3 last candles. So 1, 2, and 3. All right, we have our stop loss that will be here, and our take profit would be at least, we want a take profit of 2 for 1. So in this case, we have 71 pip if we win. So we need to have 140 pip if we lose, we have 71 pips. So we need to have 140 pips if we win. So it's gonna be somewhere around here. All right, here we go. We have our win. All right, so what's gonna happen there? As you can see, it goes against us at first, but then it comes back, it goes in the loss, and the trade wins here. So we will close our trade. It took us how much time? It took us 7 days, something around, a bit more than 7 days. In this case, no, it took us 3 days. So as you can see, in 3 days, our trade have been closed. So in 3 days, we just made 140 pips. Once again, so you understand how it works. Right now, when you start, when you just start with this strategy, as I said, what you want to do is write down your results. So how you will write down your results, what I'll ask you guys to do is simply create an Excel document where you will write down, copy the document that I'm using. So you write down entry of the trade, exit of the trade, the dates of the entry, the hours of the entry. So for our first example right here, in our entry, we will have right this moment right here. So it's gonna be the 10th of March at 6 a.m. So we can write it down on our chart. So simply write down the 10th of March, hour 6 a.m. and the closing of our trade was the 13th of March. So in this case, the closing date was 13 March, and our hour of closing in this case was at 15, so 14 hours. So the total time of the trade in this case was something around 3 days. So we know that the trade was 3 days, and the profit on this trade was 140 pips. So we can put a green color if it's profit. So as you can see, guys, your trading journal can look something as simple as this, and you can even check after that. You can check your trades after that and look how your trading strategy is. Is it bringing you money or you are losing money with it? Next thing that you guys want to do, right now that we have the strategy, we created it. Next thing that you guys want to do is backtest the strategy. So very simple. What you guys do, simply zoom out, go back at least 6 months, and you can start backtesting your strategy from somewhere here, from somewhere here. So I went out around a year, but you can start backtesting somewhere, let's say 9 months ago, 7 months ago. It should be good. So simply start backtesting, and at the end you will know if your strategy can bring you money on the long run, or at least if it brings you money in the past 1 year. In this case, you will know that it survived the last year market conditions. But if you want to have good results, the best thing to do is always to come back at least 6 months, more than 6 months. So you can come back 2 years, 3 years, 4 years in the back and simply backtest your strategy. All right, so that's it for this course, guys. We saw our first strategy, and see you all in our next class where we are gonna create our second trading strategy. Alright, hello guys, and welcome back to another class of our course about the introduction to Forex trading. So in this class, we are going to create our second trading strategy. You will see this one is a bit more complicated, but once again, it's very important that you guys listen carefully so you will be able to reproduce it. So the first thing that I'll ask you guys to do is open up the stochastic and the RSI indicators. How you do this, simply go on insert, indicators, and go on custom. So the two indicators that you guys will need is the RSI and the stochastic. Simply click on them, and then when you find them, you simply select them. All right, so how the strategy will work, it's very simple. It will take in consideration those two indicators to be able to enter a trade. So the first thing that we need will be the RSI in the, for example, over sell level or over buy level. Let's say, for example, the RSI is here. Well, let's start with this one. He is in the oversell level. The first thing that you guys will do is simply check if there is a stochastic confirmation. If it is, you mark this point. And you will only enter at the next stochastic cross that is under the oversell level. What this means, for example, you are here. Right now, the stochastic, as you can see here, the stochastic made a cross. So as you can see, there is a cross. So that's your level. This technically will be the stop loss level. You will look for the next stochastic cross. So is there another stochastic cross here? Well, no. So there is no entry that will be possible. So let's do the exact same thing for the buy position. Let's say, for example, we are here. So here we will have our first level. So right here we have our first level. All right. So there is another cross here. Technically, you should enter the trade right here, but because the second level is higher than the first one, and technically we have to put our stop loss here, that doesn't make sense. So we just move this line to here. And right now, our stop loss is there. So the only moment when you enter a trade is when there is a cross and that the cross is lower than your stop loss. If, for example, right here we have another cross, as you can see, what happens? Well, we'll move our stop loss to there. So we still didn't enter the trade, and we'll move our stop loss here. So when we'll enter our trade? At the next stochastic cross. So if there is no level here, the next stochastic cross happens there. So this is where you enter your trade. As you can see, you will enter your trade here. Your stop loss is there. So what you want to do right now, at this time, you want to have a risk reward of around 142. So you enter at this level, somewhere here. As you can see, here we have our cross. And you want to enter at 1.42. So as you can see, here we have 10 pips. So we want to make at least 20 pips. So here we will have our profit, and boom, we are profitable on our trade. So what are the important things to remember with this strategy? First, you enter, as I said, that's an extreme example right here, for example. So how you will make it work? So the first thing that you will do, you find out your level where the RSI and the stochastic are overbought or oversold. So for example here, the RSI is overbought and the stochastic is overbought as well. So technically you will open up a sell, you find out this point. That's your first point. All right. So the first point that you find out when you have both confirmations, this point will be used as a stop loss. So that's supposed to be your stop loss. Right now, if the second stochastic level, if for example this, which is the second stochastic level, would have been under the stop loss, you would have entered the trade here. If it's not under, you will use this point as stop loss. So you move your stop loss to here. So as you can see, your stop loss will be moved. And right now you do the exact same thing. You wait until the stochastic have a contact. So here we have a contact. Once again, it's higher than our stop loss. So what we want to do, we will move our stop loss here. So in this strategy, the first thing that you guys will find is the stop loss. And when you find the stop loss, the next thing that you do, you find your entry level. Then what's happening? As you can see, the stochastic goes down here. But we don't open a buy position and we don't reset our strategy. because we don't have a confirmation with the RSI. So we simply wait, and we still have our stop loss activated. So we wait, and this moment arrives. So right here is the perfect moment to enter the trade. So we can open up our sell position here because we have a cross. Once again, we don't open positions here, and we don't set new stop losses here because we don't have our RSI confirmation. Now, in the case of, for example, we started up our stop loss here, and our RSI went down there and confirmed for our stochastic to open up a buy position. We will simply cancel our last order and open up a new stop loss. So let's find out another place and do a second example just to be sure that you guys understand. So let's, for example, go somewhere around here. All right, so let's look at this place there. Here we have a concrete place. All right, so first point right here. We have our first point. We want to open up a buy position. We don't have our RSI confirmation, so it doesn't work. All right, so it's gonna be here, right there. So we have our RSI confirmation. We have our stochastic confirmation. So this place right there will be our stop loss. So we want to open up a buy position. We have our stop loss here. So the next thing we want to do, we want to find out the next place where the stochastic will be down. So this will confirm our trade. So we move. And what exactly happens? Well, here we will cancel our first trade. So this trade will be canceled because right there we have our stochastic and our RSI that are telling us that this is a sell order that will start. So what we do is simply cancel our past order. Right here, we only set up our stop loss. We didn't open up the trade. So what's happening here? We will set up a new trade here. So we start again. So right now we have our point. We have our stop loss for a sell order. We simply place our sell order right here. And the next thing we want to do, we will wait until the stochastic will simply reconfirm again. So right here, the stochastic confirmed once again our trade. All right. So this is where we will enter our transaction at this point right here. And this is where we will have our stop loss. So we start there. We have our stop loss, which is here. That's our stop loss. We have a stop loss of 55 pips. So we need to make a profit of at least 110 pips. And in this case, we have it there. So this strategy, so once again, we have another winning trade. Once again, guys, if you didn't understand, you can rewatch this class once again. I know the strategy is not easy, but I wanted to put a bit more challenge for you guys. So this way you will be able to try some new strategies that are a bit more harder. So just try it out, and the more you practice it, the more you'll see it's gonna be easy. And after that, you will be able to create your own strategies using these indicators or any other indicators. So that's it for this course, guys, and see you all in our next class. Hey guys, and welcome once again to another class of our course about trading Forex, the complete introduction. So until now, we talked about fundamental analysis, technical analysis, money management, and how to create a strategy. So right now you are able to create by yourself your own strategy, and you know exactly well how it works technical analysis as well as fundamental analysis. So in this course, we are going to talk about expert advisors, but well, what is it, how it works, and it's more going to be an initiation course than the creation of a expert advisor. So like I said, my goal here is really to give you an initiation, and explain you what is it, because in the trading world it starts to become more and more popular. So first thing, what is an expert advisor? So an expert advisor is simply a program that is written. It could be written in MQL with the language of programmation of MT4 or any other language, And the goal of this program is really to trade based on a certain strategy. So this type of, let's say, program or robots who are expert advisors are able to trade only on a defined strategy. More advanced robots can, with the use of AI, can adapt to market conditions and everything. But more basic robots that you find in the markets today will trade based on a certain strategy. For example, you have a strategy that has 2 or 3 indicators in it, and the robot will trade each time that those market conditions are met, and will not adapt to market conditions, will not trade in any other period of time than a certain period of time specified in the program itself. So as I said, if for example the conditions are not met, well, the trading robot will not pass a trade. So the goal here of a trading robot is really to pass trades for you, and it could be a good thing because it takes away all the emotions, and it will automatically pass the trades 24/7. Well, 5 days a week, because the weekends the markets are closed. All right. Second thing, is it worth it to buy a trading robot on the internet? So is it worth it buying an expert advisor on the internet? From my personal point of view, that's the worst thing you can do. Why? Because if a person is selling you a trading robot, that means that this person is not able to make money from it. Well, why? Because as I said, if a trading robot brings money, well, a person will not simply go and sell it on internet for, let's say, $50, because that just doesn't make sense. As I said, the goal of an expert advisor is really helping you growing your account. And if a person has an expert advisor and is able to grow its account, you gotta ask yourself why this person will sell me a robot or an expert advisor. If, on the other hand, you are building up your own expert advisor, that's another thing. But you'll see it's not easy. At first, you need to know perfectly how to trade. You need to have good experience in trading. You need to develop your own trading strategy. And after that, you need to program your robot. So you need to learn how to program in MQL and then create your own robot. After that, you need to backtest your expert advisor. And once again, it takes a lot of time. It's not an easy task, but it can be done. If you are creating it, that's, as I said, another story. That could be a good thing. But if you're only buying an expert advisor from the internet, I honestly don't suggest you guys to do this. All right, third thing, automated trading versus manual trading. So there are advantages to automated trading. As I said, if a strategy works and you are able to prove it, and you backtested the strategy, and you backtested even with the expert advisor, and you see that you had the positive returns in the past years, well, maybe it's a good thing to use automated trading in this case, because the expert advisor will place trades 24 hours per day. This means even when you're sleeping, the robot will continue to place trades, so you will be able to make money non-stop, which is a good thing. Because if you're trading manually, well, you will simply not be able to place all those trades, and at the end of the day, you will lose trades that you have not been able to place. This is why trading with a robot can be a good thing. But once again, if for example you change strategies, or something doesn't work in the markets, your robot will always follow the strategy. This means that if the strategy stops working, the robot will still continue following it. And if you don't stop it, well, it will simply blow your account away. Compared to manual trading, you as a person, you can adapt to market conditions. So for example, if you see that market conditions doesn't work anymore for the strategy, or you need to optimize the strategy, well, you can do it as a person. But if you own an expert advisor, he will not adapt by himself or by itself. You will need to make the modifications to this machine so that the robot will work or be optimized. Next thing, what type of strategy is used by expert advisors? As I said, they have plenty of strategies that are used. The only one that there is not really, well, the only thing with expert advisors is that they don't really trade fundamentals. But once again, I'm not honestly, I can't really say what are the new things that are happening in this world. Maybe there are some super smart expert advisors that have a lot of EA in them, and they are able to trade on fundamentals. But usually expert advisors trade simple strategies, and or will trade really well, they will trade really really small time frames. So they will trade, let's say, on even smaller than minutely charts. So this is really the goal of expert advisors. They will be able to catch really small movement in the price, and will be able to make profit just on those small movements. But expert advisor that are used by everyone, they can trade any type of strategies that have, let's say, indicators or something mathematical in it, because you can put it directly on a paper or you can program it. But it doesn't really have fundamentals in it, because you can't really program fundamentals, and there is not always the same result when fundamentals are released. So for example, if 1 year you have the interest rate that is released, and the next year you will have the same interest rate that is released, well, the markets will not react the same way in both years. 1 year maybe the market will become very volatile, and the year after the market maybe will stay really, like, will keep its normal volatility. So this is why expert advisors usually trade basic and simple strategies. So this is for expert advisors. I hope you guys now understand what is it exactly. As I said, my goal here is not to help you create an expert advisor, it's just initiating you to this and make you understand that this exists. And besides of that, my goal is really to help you learn how to trade from A to Z. And the expert advisors are part of the trading, and in my opinion, it's very important for you guys to know all this. So that's it for this course, guys, and see you all in our next class. Hey guys, and welcome back to another class of our course about the introduction to Forex trading. So in today's class, we are going to talk about hedging. So what is hedging, how it works, and how this can affect our trading style. So let's start. All right, so until now we talked about technical analysis, fundamental analysis, we talked about money management, and we also created different trading strategies. So right now it's time to learn how you can cover up your losses, in case that, for example, you want to use a strategy to cover up your trades. So one good strategy that you can use is a strategy of hedging. So this strategy, what exactly it does, and what exactly is the definition of this strategy? Well, it's very simple. It's the principle of buying, let's say, a currency, but at the same time selling this currency. So you're buying a currency and you expect it, let's say you have your take profit, but instead of placing a stop loss, you will simply sell the currency. So for example, if the currency falls down, you will have another order that will be a sell order that will automatically open and protect you from losses. So this is a great strategy to protect people from losses, and it can be used directly, as I said. It's usually used to protect from losses. There is a lot of big firms and hedge funds who use a lot of those strategies to be able to not only protect from losses, but also to be able to trade. All right, so how hedging can be used? So it can be used in two ways. The first one can be used in direct trading. So you can make trades and make profit only by hedging. So for example, you are using a hedging strategy. Well, you can make profits only by using this strategy. So no indicators, no price action, no nothing, only mathematics and hedging. It's possible. Once again, it's very hard, and there is a lot of aspects that needs to be taken in consideration, since it's very simple, but it's not easy. It's like trading. Trading is simple to understand, but it's not easy. So it can be used this way, but it can also be used to protect your capital. So for example, you have an account and you open up a trade and you want to protect yourself from losses. You can open up a hedged position, a position that will protect your account from let's say losses. And this way you will be protected against all those losses and against everything. So what are the ways to create a hedging strategy? So one of the most popular, the first way, if we talk about only trading, it will be opening a buy and a sell at the same time. This can be a way to create a hedging strategy only for trading, the purpose of trading. But once again, as I said, it's not as easy as it sounds. You need to take a lot of things in consideration to be able to make a good hedging strategy. In the other case, you can lose all your account really quickly with this type of strategy. But it can also be used to protect your account. In this case, it's a bit easier and it works. What you can do is simply, instead of placing a stop loss, you will place a reverse position. So let's say you are opening up a buy. So let's say you have a buy order, and instead of placing a stop loss to your buy order, what you will do, you will simply place a hedging place. So you will place a reverse order. So you'll place a sell order, and when the sell price will be crossed, you'll simply open up a sell transaction, and this way you will protect yourself from losses. What are the positive aspects of hedging? So as I explained, it can be, the first positive aspect is that it helps you protect your capital. So when you if you're opening up positions and everything, one of the very, very positive aspects is that they can be protected by using hedging strategies. And also it can be very, very profitable if you know how to trade it. If you know how to trade hedging strategies, like only hedging, strictly hedging for trading, if you know how to trade it, this can be very, very profitable. And the negative aspects of hedging, of course, is that if you overuse it, it can just destroy, your account will be at max risk. You'll risk a huge part of your capital without even spotting it. So this is one of the negative aspects of hedging. So it's not risky, but if you overdo it, it can just wipe out your account. That's one of the negative aspects of hedging. So you need to be very, very careful. You can open up one hedging position, and don't try to over leverage your hedging positions. A lot of people, what they do, they open up, let's say, a buy order, and the position goes against them. So they open up a sell order, which is much higher. Then if the transaction goes once again against them, they'll open up another buy order way higher. So you need to be very, very careful about those type of things. And another negative aspect about hedging is that you can do it in all countries. So if I'm not mistaken, in the US, it's prohibited, or you will simply not be able to do it when you will open up a trade. You will not, for example, you are opening up a buy position, you will not be able to open a sell position with this currency. So for example, you open up a buy on the Euro USD, you will not be able to open up a sell on the Euro USD at the same time. So this is one of the negative aspects. But besides of that, hedging is pretty much a good thing. The only thing is that you need to know how it works. So that's it for this course, guys, and see you all in our next class, where we are gonna learn how hedging works and practice it. Hello guys, and welcome back to another class of our course, which is the Introduction to Forex Trading. So today we are gonna talk about hedging and how we can make hedging strategies. To try out hedging, as I explained in the first course, what you can do with hedging, you can do covering strategies, cover yourself and protect yourself, and also you can use it to trade. So this is what we will do today. We are gonna practice these two strategies, and how we'll do it is very simple. We'll use a program called Forex Drive. I personally use this program and I really like it for backtesting. So what I'll ask you guys to do is simply go on Google and write down Forex Thrive. It's gonna be the first one, so simply click on it and click on Go Backtesting. Alright, so when you are here, the first thing that you guys want to do is go on Simulator, select the account type, simply select Hedging, give a name to your strategy. So you can call it, let's say, name. Oh, I already have a strategy called name. So you can call it name. Here, equity, put $10,000. And your instrument, you can use Euro USD. You can click on add and then simply click on start. Then you will be on a page that looks like this. So this is the chart of the Euro USD for 2012. So it's this program is really made to backtest. So this is why I really like it. You can backtest back in until 5 years ago. Also, all the charts are from TradingView. So once again, this is a really great thing, and you know that the charts are quality charts. You have all indicators. You have a lot of really interesting things. So as you can see, all indicators are here. The only thing that I like a bit less about this type of graph is that on weekends you have lines like this. So instead of just disappearing, well, you have lines. But besides of that, it's a really good backtesting device. So as you can see here, you can play with the speed. So let's say I want it full speed. I can simply click there and it will move. Those are hourly. So those are each candle is 1 hour. I can go up to 1 day. And if, for example, I want to jump 4 hours ahead, I simply click here and click on jump. So as you can see, 4 candles will appear. All right. The only difference between this app and MetaTrader and other apps, well, instead of using volume, you will need to write your contract that you want to trade. So let's say in MetaTrader, when you want to open up a trade of, let's say, 100,000, you will simply write volume of 1. So you'll write 1. In this case, you will need to write 100,000, which is the size of the contract. So in this app, you'll write down the size of the contract, but in MetaTrader, you will simply write down your volume. All right, so let's start. So as I explained to you guys before, there are 2 ways that you can use a hedging strategy. So in this case, for example, let's say we want to open up a trade. So let's say I'm opening up a buy position. Let me just make, because it's a bit too big. So let me just open up a buy position with 10,000. Here we go. All right. So what we want to do is open up a sell position somewhere here. So lower there. In this case, if the price falls too much, I will have a position that will protect my transaction. I will have another transaction that will protect my initial transaction. So I will put my sell order at 1.2275. So it's going to be a stop order at 1.2275. I will simply suppress all those things and click on submit. Then we can make a play. And the moment, if for example, the price goes in the other direction and crosses 1.2275, a hedging position will open. So as you can see right now, I'm making money, I'm losing money. And if the price goes too low, I will have another position that will open and protect my initial price. So as you can see here, this is what happens. And as you can see, my, not my price, but my transaction is protected. So I am protected. I'm only making $42 of loss, sorry. And it's always gonna stay like this. So even if the price goes really low, I only make $42 of loss. So as you can see here. And what's gonna happen when the price will come back up? Normally my transaction will close once again. So I will close the short transaction and I will only keep the long transaction. So when it comes back to this price, I reopen my short transaction. So this way my price is always protected. My transaction is always protected. And the only cost that it costs me to protect my transaction will be the cost of the commission. So this is for our first way to use a hedging strategy. The second way of using a hedging strategy will be by directly trading the markets. So I personally, how I use it is very simple. I open up a buy and a sell order at the same time. And then I simply open up a new trade every 4 hours. So you need to close every trades that are in profit, but leave at least 5 pips of profit. So each 4 hours, if you have at least 5 pips of profit, I'm closing the trade and I'm opening up a new trade. So 1 buy and 1 sell. And I do the exact same thing again and again. And at the end of the day, it can bring you interesting profit. So as you can see here, I have my profit. And if I come back and close the transactions, as you can see, all my transactions are in profit. And when I make the addition of all those profit transactions, they are far greater than my transactions that are here. And my my profit loss. Even if my profit loss is $219, well, at the end, I made more money. So as you can see here, I closed more money. Well, I made more profit, sorry. Alright, so right now you understand the two ways that you can use your hedging strategy. You can use it to protect yourself when a trade is open, and you can also use it to, you can also use it like this to be able to make profits from trading. So very important when I was talking about not using too much hedging. For example, if you start opening up really big transactions, in this case, for example, let's say I'm opening up $50,000 and I start doing this. So as you can see, yes, I can make money at first, but what's gonna happen is that at a certain moment, I will start making losses, and this is where it's not good. Or if the price moves too much, well, at the end of the day, I will make more losses than wins. So this is why you need to control everything. So what I suggest you guys to do is really to try it out. And by trying it out, you will be able to figure out if the strategy is for you or is not for you. So besides of that, that's it for this class, guys. And see you all in our next class, where we are gonna talk about options and hedging. Hey guys, and welcome back to another class of our course about Forex trading. So in this class, we are going to talk about hedging strategies with options. So just to be clear, this course is not about option trading, and my goal right now is simply to give you guys an introduction to options and just to let you know that those financial products exist and you can protect yourself with the options, strategies of options. So let's start. So the first question we're gonna ask ourselves is, what is an option? So theoretically, an option is simply, a currency option in this case, because we are in Forex. It's a contract that will give the buyer the right, but not the obligation to buy a certain currency at a specific exchange rate or before a specified date. So in other words, you have the right, for example, when you are buying an option, you are buying the right to buy a currency or a financial product at a certain price. So if this price is reached, you have the right to buy it. If this price is not reached, and let's say you have a loss that can be occurred, so let's say the price falls when you want to buy this product, you take no risk. So the only risk that you will take is the value of the prime that you will pay on your option. So this is the only risk that you will take when, for example, you are trading an option and you decide to cover yourself with an option. So what is the difference between hedging and the use of an option? So let's go on the graph, and I'll explain you a bit with this. It's going to be a bit easier. So let's take this graph right here, for example, and just delete the indicators. All right. So let's say, for example, we have this graph right here, and we decide to open up a buy order somewhere here. So we are unlucky. We open up a buy order here. So logically, what's going to happen is that we will open up a sell order there. Theoretically, if we decide to hedge. So if we hedge, we open up a sell order, let's say somewhere around here. So we making a loss, but instead of taking the loss, we open up a sell order. So we are still making a loss of, in this case, 50 pips. But once again, this is hedged. So even if the price falls, we'll not close our position. We'll keep it open. But in the case of an option, what you can do, for example, you open up a trade here and you decide to open up an option right there. So you have the right to sell the currency at this price. So the cost of your option will be the difference between the two values. So between this value and this value, at least this will be the minimum cost of your option. But that's it. That's the only risk you take. So for example, if the price rises up, you are making profits. And if the price falls, well, you close this trade right here, or you can even leave it losing. Your option right there that you just took will take the lead and will bring you profits. Because normally what you will do, for example, here you open up a volume of 1, you will open up a volume of 2 in your option. So this way it will fall, but you will still make a certain profit. The only problem with this is that you will have to pay a primus for your option. So to be profitable, your trade will need to at least be higher than 50 pips, because it's gonna cost you at least, well, in this case 60 pips. So you'll need to make at least 60 pips of profit. So both strategies are very interesting. Where exactly options can be better than hedging, in the case that options can, for example, give you the opportunity to buy at a certain price without risking nothing at all. And also you can open up higher transactions with options. And if you start doing this with hedging, well, you will blow your account. You have a lot of chances to blow your account. But with options, it's a bit different. You can just you can open up higher positions with the options, and you have no risk at all. Well, the only risk that you have is the risk of losing the primus. But once again, this is calculated in your trade normally. So this is the difference between options and options and hedging. So now you understand a little bit. The next thing we will ask ourselves is, what is the risk associated with hedging strategies with option? So as I explained, the only cost associated with the options is the cost of the primus. So when you are purchasing an option, it's like paying for an insurance. So you are buying the right to buy or sell at a certain price. And to own this right, you need to pay a primus. And this prime is the only risk that you are taking when you are trading options. So if the price falls or goes up, you don't care because you don't have to take this risk. So this is for the risks associated with the hedging strategies with options. The last question is it worth it to use options? In my opinion, yes, but once again, you need to know how to do it. Because once again, if you don't know how to trade this financial product, you will not be very you will not be very profitable. You will even make losses. So before using it, I really suggest you guys to learn how to use it, and then you can maybe protect yourself with options. But until now, I suggest you to just maybe learn how to hedge. This could be a good beginning. And also what's cool with options is, for example, in the US, you can do hedging, but you can use options to protect yourself. So this can be a good way, let's say, to protect. You can still protect yourself with options, but you can't hedge. This is the only, let's say, difference. But as I said, it could be really, really worth it if you know how to use it, and if you know what's the volume that you will use to protect yourself. Well, it could be really worth it. And even if you're not trading, let's say, Forex, and you only trade options, it's possible to make good amounts of money if you know how it works. So that's it for this course, guys. Right now, I hope you understand what are options and options in Forex, and how you can protect yourself with options, the difference between simple hedging and also options. But besides of that, that's all that you guys have to know. So see you all in our next class, where we'll talk about emotions in trading. Hello guys, and welcome back to another course of our class about Forex trading. So in today's class, we are gonna talk about the importance of emotions in trading, and how this can affect your trading career. Alright, so what is the role of emotions in trading? Like in everyday life, when something happens to us, we tend to react in a certain way. If something joyful happens, we'll be happy. If something sad happens, well, we will be sad. If something stressful happens, we'll definitely be stressed. In your trading career, that's gonna be the exact same thing. So, when, for example, you will be in profit, you will open up your transaction and you will be in profit. Well, what's gonna happen? You will be happy. You will want to close your transaction right now, take the profit, withdraw the profit, and go buy yourself something. But in the other case, if for example you will be in losses, well, you would like to keep your position open until it comes back to the profit. But once again, this is a very bad way to trade. Why? Because you let your emotions dictate what you will do in your trading. Will let you dictate how you will modify your trading plan. All right, so what you need to understand right now is that when you trade, you need to have a trading plan, which is very, very important. Which means, let's say, for example, if this happens, I will do this. If, for example, I'm in losses, I will do this. I will close at this level. If I'm in profit, I'm closing at this level. And when you are trading, you need to stick to this trading plan. So you stick to your strategy and your trading plan. But with emotions, what happens is that you start trading without the use of your trading plan. You have your trading plan, you know that's the right thing to do, but because of emotions, you will start to just not do it. So what's very important right now for you to understand right now is that when you are trading, what you will have to do is you need to take emotions out of trading. And the best way to do this is to practice at first on demo accounts, and then trade only small lots on live accounts. Don't start putting all your savings in your trading account, and never borrow money to trade. Because if you're starting doing this, you will see your stress level will be too high, and because of the emotions that all this situation brings you, you will have more chances to lose your money than to succeed in the trading industry. So very important, guys. As I said, trade always with your money and only trade with money that you can afford to lose. So as I explained, this is why you should never trade with emotions, because when you are trading with emotions, you are simply not rational. And if you are not rational, well, what's happening is you make mistakes. It's like in anything in life. If you are at work and someone is stressing you out, you have more chances to make mistakes. And if you make mistakes, well, you are more stressed. And what's going to happen? You have even more chances to make mistakes. This is the exact same thing in trading. If you let your emotions control you, you will make mistakes. And by making mistakes, you will be more stressed, you will get more emotional, and you will make more mistakes. So this is why you need to always stay to your plan. Start with a demo account, and then only trade small lots. This takes us to our last point, which is know when to stop. So you are the only person who knows when you have to stop. It could be on a losing streak, but it can also be on a winning streak. Let's say, for example, you are winning, and you start to become confident, and you decide to open huge lots. And this is what usually happens to traders. They are on a winning streak, they opening huge lots, and what's happening? Well, one lot wipes out all their profits, and sometimes even their account. Or other traders who are in a losing streak, and they start getting bigger, putting bigger and bigger lots to trade. And what's happening? They just lose everything instead of winning, because they expect to win at least once. And what's happening? They lose everything. So the best thing that you can do, guys, is just don't trade huge lots, and stay focused on your trading plan. Never, get out of it. And if you see that you lose too much and that you're becoming too emotional, the best thing to do is really to just turn off the computer and go do something else. Because if you continue trading and you force the trades, well, you'll see you will do more harm to yourself than good. So right now you understand the importance of emotions in trading. Once again, this is just introductory, and this can't really be explained. You need to practice it. You need to feel it to be able to understand what is it. And just with that practice, you will be able to master it. So that's it for this class, guys, and see you all in our last class. Hey guys, and welcome back to our last class of our course about Forex. So in this course, we saw a lot of things. We saw how to choose the right broker. So until now, you are supposed to have your own broker. You are supposed to have MT4 installed on your computer. You know how it works TradingView. We saw all the basics of trading. You know how it works fundamental analysis, how to perform a fundamental analysis, where to find fundamental analysis data. We talked about technical analysis, how it works indicators, where you can find indicators on MT4, how to use indicators, how to use price action also. We put indicators and price action together. So you right now are able to do this. After that, we talked about creating strategies. So you know how to create your own strategy on Forex, since we created 2 strategies together. And right now you know exactly all the steps that you need to take to create a good Forex strategy. We talked about money management and how you can manage your money when you are trading, how much money you should risk per trade, which is once again very, very important in the trading industry. After that, we had an introduction to EAs. We talked about expert advisors, like just in introduction. We talked about hedging, we talked about options, but once again, all this was just in general. And once again, you got access to another free software, another free place where you can go and test your strategies. It could be hedging strategy, it could be all the strategies that you want to test. I gave you a reference of a place that you can go and test it. We finally talked about emotions in trading. So I think right now you have all what you need to be able to go in the trading world and practice everything and simply build up your own strategy. As I told you guys, there is no strategies that can pay millions of dollars. It's all about practice, practice, and practice. Even the best strategies that exist, if you don't practice them and you don't practice trading, those strategies won't work for you. So very important, guys, with all this knowledge that you have now, it's time for you to practice. So create your first strategy, learn how to backtest it, recreate another one, learn how to backtest it, and eventually you'll see, you'll create, the more you'll create strategies, the more you'll optimize them, the more it's going to become easy, and the more chances you will have to make a living from Forex if this is your goal. Besides of that, guys, I really would like to thank you all for joining my class. Honestly, it's really appreciated, and that you completed the course. It's an honor for me to be able to teach you guys. And once again, thank you all for the support that you're giving me by taking my course. Besides of that, if you have any question about anything in this course, you can write me down directly here. Don't hesitate. I'm very, very easy to contact, and usually I answer pretty much quickly, but it takes me around something like 24 hours. Normally it takes me 24 hours, and I am able to answer all the comments and all the messages that I receive. Besides of that, guys, thanks a lot, and see you all in another of my courses that you guys would love to take.